Okay, folks, welcome to the week ahead commentary. Let's kick things off with the economic data that was released last week. And the only real serious piece of economic data that was released that I want to talk about is core CPI. Core CPI is cited by the Federal Reserve as being their preferred barometer of inflation. Why? It's because it X's out food and energy as if you don't pay for that. The reason why they X out food and energy because they believe it to be volatile. So we'll use their preferred metric, the core CPI. The core CPI came in higher than the prior read, and it also came in hotter than what was expected by a mile. This is a big beat. Yet, the Federal Reserve is going to cut rates this month. Now, before we leave this, producer price index expectation was for a negative number. Actual, spot 1%. So what happened to the yields last week with the fact that we had a Federal Reserve chairman, very dovish, yields rallied. Remember, for the past several weeks, we've been talking about that this was an unsustainable downtrend on yields and that we should expect a rally. Last week, we got a bullish key reversal after hitting a one handle. Now, we're above 2.1 on the 10-year yield. So what's going on here? The thing to remember is that the Federal Reserve has very limited powers to influence long-term bond yields. So while they can influence short-term yields to really soak up the supply of 10-year, 30-year Treasury bonds, 20-year Treasury bonds, they need to go into the market and begin to buy those bonds. Therefore, what I'm expecting is another round of QE, because if this trajectory continues, you're going to see the market rally begin to wane and then begin to roll over. It's too early to make that call right now. I think that based upon the charts that I have gone over already, I think that these markets are going to move higher. They'll shrug off last week's knee-jerk reaction of the 10-year yield. But the longer-term picture that we want to keep an eye on is this chart here. This is a quarterly chart, the 30-year bond price. Remember that we broke down below this lower band of support 1 year ago, and we have since rallied back. Now we are in the first month of Q3, so a lot can happen here. Perhaps we'll head higher. Perhaps we won't. So what we'll be watching for here is the potential in Q3 for a lower high on the 30-year bond price. Because remember, this, for all intents and purposes, this 30-year bond price has driven the American lifestyle, the lifestyle of living on credit cards, since 1981. If this comes to an end, the American lifestyle, as you know it, comes to an end as well. So what I'll be looking for are rumors, signals, signs by the market that the Federal Reserve is not just simply going to cut rates. That's not going to be enough. There is an expectation of a 0.25 percentage point cut in July. That is nothing. That is nowhere near what is going to be required to keep this stock market alive through the 2020 elections. They are going to need to come out with a bazooka, half-point cuts, and they are going to have to restart up the printing presses. They're going to kill the dollar. They're going to buy long-term bonds. It is all but a foregone conclusion. But I think that what we're going to have to see first is the market sell off on a 0.25 percentage point rate hike. Because remember, we'll get the 0.25 point cut. We may get a knee-jerk reaction to the upside. Yay, we got a rally. We got that rate cut. What comes next? What happens when you have long-term bond yields continuing to move higher? What will the markets do? That's when the conversation will begin to change to the Fed is behind the curve. the Fed must be more aggressive, i.e., buying debt to influence long-term bond yields. This, folks, is not going to end well, but we'll be ready. Now, on a quarterly basis, looking at bond yields, I'm spending a lot of time talking about bonds this week, folks, because they matter. Yields are what is driving this market, the stock market. Have no doubt about it. And I've spoken about this chart in the past, and I want to revisit it because the last time we spoke about it was back here, last quarter, only a couple of weeks ago, and we were hitting the breakout point. Remember, we were in a long-term downtrend, which began back in 1981, 1982. We broke out right here. Q4 2016, we bounced around, did a retest, rallied. Now we have pulled back to retest yet again. What did we do so far this quarter? And again, it's the first month of Q3. A lot can happen here. We can go higher. Perhaps we'll break the support level. But as it stands right now, this snapshot in time, we have flashed a bullish key reversal off of a prior support level. Again, folks, this is not good for the stock market. Right now, the markets will absorb this price action. But when we begin to rally up to 2.5, 3%, the markets are going to buckle. Unless, of course, the Federal Reserve begins to buy debt. I predict that they will. And I do not believe that the second term of President Trump is going to be a great one. I think it is going to be one of restructuring. And there will be several years of very hard times for a lot of people, the middle class in particular. Let's take a look at oil. Oil is poised to shoot up higher here. And you may be saying, won't that influence the Federal Reserve? If we get a rally in oil, if it begins to break out and gasoline prices shoot up? Not at all. Because remember, it's the attitude of the Federal Reserve that they believe that food and energy should be backed out of any inflation numbers. Therefore, they will only go by the core CPI, which excludes food and energy. So oil can go skyrocketing to the moon for all they care. It doesn't matter in their book. Let's start talking about the stock market. We'll begin with the VIX. I think that the VIX is going lower. I think that we're probably going to go down to the single digits yet again before we get a big blow off top in this market. We'll talk about the dollar later on when we talk about gold and silver. Let's stick with stocks right now. The Dow Transports, a bullish key reversal week last week. Very powerful week. This influenced us to go opening up a trade on KSU, Kansas City Southern. We broke out on Ultimate Oscillator. We broke out on Stokes. Volume is a bit light. I think we move higher here on the transports. No breakout yet on RSI. The Dow Jones Industrial Average, an outside reversal week last week. That sets the stage for a new all-time high on the Dow Jones Industrial Average. We're going higher. Volume is light. The NASDAQ Composite, another outside reversal week. A new all-time high. We are going higher, folks. The S&P 500, a new all-time high, a bullish key reversal week. And we closed right at the highs of the week. We are long of the S&P 500. We will remain long for the short term anyway. The IWM, there's a lot of chatter out there that the small caps, they closed down last week, they're underperforming. This is a canary in the coal mine for the markets. I don't think so. I think that the small caps closed fairly well last week. Yes, they were down, but they did rally off the lows of the week. I think that they will probably break out in the next week or so. Would I buy them here? No. I'd wait for the breakout. The pontificators could be right. We have a higher low on Ultimate Oscillator, a beautiful double bottom setup here. And we broke out last week despite the fact that we closed down on price. Daily chart. So daily chart, we did make a new daily high on Friday. We pulled back though. RSI looking rock solid here. Higher lows. We're set for a breakout. Stokes are hooking up. Higher lows. I differ with those out there saying that the IWM is weak and signaling that we will probably see a rollover here. I disagree. I think that the IWM is going to break out probably this coming week along with the rest of the market. The semis, I was rather bearish on them last week, and we did put in a new weekly low this week. However, we reversed a bullish week. We're going higher on the semiconductor sector. Volume was horrible, but volume be damned, earnings be damned. It doesn't matter. It's all about the Federal Reserve and traders getting their heroin injection, but it won't be enough. Healthcare, bad week. It's a defensive play. It was a risk-on week, so I wouldn't buy here. I wouldn't necessarily sell. It'll probably trade sideways with a bias to the downside, perhaps retest this breakout point, and you can look to add there. I think that all sectors will eventually rally with this market. Daily chart. Holding 92 on the XLV. Again, I wouldn't buy here. Volume rose. I wouldn't buy here, but I wouldn't be a seller either. If you're long term, if you bought this as a short term trade, then obviously you put in a new weekly low, a new daily low. You want to stop out of that position. Technology, outside reversal week last week. We're going higher, new all time high, and we closed there. Volume horrible, but don't look here. It doesn't matter. It's crazy. We are entering lunacy land. The Wizard of Oz and Willy Wonka's Chocolate Factory have nothing on this bizarro story that we are seeing play out in front of our faces. We have the largest number of companies reporting guidance lower since 2006. What are stocks doing? They're breaking out to new all-time highs, and they're going higher. It doesn't matter, folks. It's all about the Fed. Energy. An inside week last week. I think that we're breaking out on energy. In fact, I think that it's soon to be a buy. Put it on your watch list. Get ready. It's going higher. They're going to take crude higher because they have to. Why? Jobs here in the United States. High-paying jobs. The problem for U.S. frackers is that they produce oil, but with the tightest margins than any other country. And if the price of oil drops, what drops as well? I keep going over this, but it's important to remember the junk bond market. And the junk bond market is trading sideways. It's probably going to head higher here. So back to energy, we're looking for a breakout above resistance level 1 and then resistance level 2. So at $32.50, then $33 per share, it's game on to the long side on energy. We'll be going a lot higher, especially if we break out weekly basis on the price of oil. The utility sector, new weekly high last week, but we had a reversal week. So I think that we're going to probably trade sideways on the utilities. I wouldn't be a seller here because there's a chase for yield. I'm not loving these indicators. Lower highs, choppy action. It wouldn't be a bad idea, especially with the 10-year yield rallying, which I have overlaid here in black line chart. It wouldn't be a bad idea. If you have some profits, you want to make them real, do so. You want to sell some covered calls, you're probably not going to get much premium. However, if you go out in duration, 3 months, 4 months, you'll get some premium. If you sell just out of the money, covered calls. But you could bet your bottom dollar, once they go back to QE, the utilities are going to rip. Housing, poised for liftoff here. A bullish key reversal on the week. So a name to watch, KB Homes, looking good. Very consistent with the HGX. So let's add that to our watch list. The biotechs clubbed over the head last week. But again, I think that these defensive names are going to take a backseat to the sexy semiconductors, the sexy internet names. So while, yes, a very bearish week last week for the BIB, I'm not overly concerned here. So here's our price action on a daily basis. On Thursday, then Friday, we bounced off of the $48 per share level, which is fairly good support. Would I be a buyer here? No, but I think that we're stuck in a trading range and that there will be opportunities to add more. We're along with the LABU, which is similar price action. I'll go over that chart in a moment. A similar price action here. So I'm not all that concerned. I think that as the more popular names become overbought, you'll see a rotation into the biotech names. And between now and then, we'll be accumulating a position in the LABU and prepping for that rotation out of the very popular internet names and into the biotech arena. The banks, yields rose, the banks rose. A very good week last week, flashing a bullish key reversal. The DPST is back on our watch list. Let's bring that up. Okay, DPST, a down week last week, but a consolidation week. We rallied off the lows. The breakout is still intact. Volume is very low. Let's bring up the daily chart. Yeah, this is ready for liftoff. So we'll be looking to buy the DPST early next week. So stay tuned. Our portfolio is getting a little bit heavy to manage. So I'm not looking to add much more in terms of positions. All right, to the dollar, because we're going to talk about gold now and silver. So the dollar is weak and in all probability will get a lot weaker. It is now in the crosshairs of the Federal Reserve, of Treasury. We flashed a bearish key reversal week despite the fact we put in a new weekly high after a big week the prior week. We got slammed down last week, closing back down below support. We closed below a 97 handle. This was a horrible week for the dollar. So that sets the stage for a big move higher on gold. I'll begin with the negatives first. We have a lot of topping action here. That's it. No more negatives. Now to the positives. We have bottoming tails, which balances out the topping tails. What do we have? Indecision. Indecision within a triangle formation. As the trend is clearly up, the resolution favors the upside. I think that we are breaking out, and we are going to break out in a very big way. I don't think that $2,000 an ounce for gold by Christmas is out of the question. Why? Two reasons. Election 2020 and this chart here of the 30-year bond price. Remember, this is the American dream. For the past 30-odd years, this is the American dream. And for the first time in over 30 years, we closed down below the lower band of support in Q3 2018. That, folks, is a tell. I digress. Let me get back to this. All right, so gold looking rock solid. I think Stokes are going to hook up. RSI already has hooked up. Volume is just outstanding. Institutional accumulation. Nugget, weekly chart, we're up nearly 9 1/3% last week on this trade. We did not sell covered calls last week. Why? It's because we had a very strong week. We were closing near the highs of the week. That sets the stage for a continuation move higher this coming week. So I don't want to put a cap on any of our position right now. I would rather wait until we begin to near resistance levels at, say, $35, $37 per share, perhaps 40. And I think that we're going there very soon. So I do not want to cap our upside potential right now. That's the downside of trading covered calls. Now, I was a bit nervous earlier in the week. That nervousness was alleviated somewhat. If you wanted to sell out of the money puts, say the 27s, the 26s, okay. Even the 28s, but stay small. because that's a very bullish trade. And you may be saying, what's the difference about being long of the shares of NUGT and selling naked puts? When you look to set a stop loss on a right, meaning whether you sold a naked put or a naked call, and it doesn't necessarily have to be naked, it can be covered as well. But you need to enter what you call a buy stop order. And many times you need to call the brokerage, they expire at end of day, and you need to do it every single day. If you're not disciplined, well, then your risk level just went through the roof, rather than being able to just log on to your brokerage account where you just long of the common shares and just entering a stop loss order, trailing stop, whatever, limit stop. And of course, if you have a buy stop that's triggered, you're going to get out at a horrible, horrible price. I mean, it's just going to be disgusting. Now, you can cover a naked put, but you need to be short of NUGT. And I don't think you want to be short of NUGT right now. So back to the chart. RSI is rising. Stokes are rising with a higher low. We expected a double bottom setup. We got that double bottom setup, and we have now broken out. Bullish key reversal on the day, if I didn't already say that. I think absent dovish news by the European Central Bank over the weekend, which will force the dollar higher on Monday morning, Sunday night, we'll probably gap up higher early next week on NUGT. To the USLV, very, very quiet. We are setting up for a major move higher here. We did not put in a new weekly high. It was an inside week last week. RSI is creeping higher. Volume is subdued. All eyes are on gold right now. So I think this coming week, we want to start focusing in on adding more. Yeah. This is what we've been looking for. This is the price action. Adding more to USLV. I think on a new weekly high, USLV can be bought. Here, we have a breakout in RSI, a retest of that breakout point, and we are now hooking up. Volume is light on Friday. Ultimate oscillator, weird, very weird, in fact. Lower highs and lower lows, breaking down. So this needs to get resolved. Very strange. All right, LABU, we already spoke about the BIB, so I won't spend much time here. LABU may pull back to a 44 handle, no big deal. If we get that, we'll look to add more. Stoke RSI continue to press higher despite the fact we had a bearish week on price. Daily chart. We have both lines on Stokes down below 50. It broke, so did RSI, but we're consolidating here. I won't worry about this until we break down below $43 per share. Then we need to stop out of the trade. So right now, we'll give it some room. I think with the markets pressing higher, that'll keep a bid under the LABU. It'll keep it from falling apart. And then again, as the more popular names become overbought, then you'll see a rotation into the biotech arena. Two new trades last week. CMG, Chipotle Mexican Grill. It passed our test, which was a breakout above this upper band of resistance here. We're looking to add more on a close above $7.60 per share. That would make it a new all-time high for Chipotle. What a trip that investors have had here. KSU, weekly chart. We broke out. Last week, the prior week, we put it in a doji star formation. This past week, we retested the 120 level. This is what we spoke about. And we got that retest. We rallied, so we opened up our trade. So KSU looking good. Leaving off with the EDC weekly chart. We bounced off of support last week. Volume a bit light. Very light, which is good. Daily chart. Bullish reversal day on Friday. Stokes is still down below the 50 level. I like to see both lines hooking up, moving higher. RSI putting in higher lows. If the dollar continues to break down next week, we will look to add more to the EDC trade. So more to come this coming week. And that is it for this weekend, folks. Oh, by the way, reminder, tomorrow night, 6 p.m. Eastern Standard Time, please join me in a webinar with the team over at TrendSpider. They're really nice guys. We're going to have a great time. Bring your questions. If you want me to go over a couple of symbols, I will. Click the link that I provided in the email for this week's The Week Ahead commentary and register, please. And hopefully I'll see you there. Please let me know if you're coming, all right? Send me an email. Everybody enjoy the remainder of your weekend and be well.